So here the pleasure, apologies for technical glitches. And let me start right away. In the interest of time, I would like to present this work, joined with Sathya Ramesh, who is also here. We were debating whether he should be presenting his favor, but in the end I decided to do that. And it's about like really understanding the cost of leverage in this cryptocurrency market. And this is a project that we've been working on for about a year or so. And the main idea is to understand, basically, try to give an explanation for why we observe such a large growth in DeFi, and also try to understand whether this can be attributed to new financial innovations such as perpetual futures. So in fact, if we look at what happened in the current cryptocurrency ecosystem, we have seen two main somehow growth areas. One has been CeFi, centralized finance, where we have seen increasingly larger volumes of in the exchange, and these volumes are dominated by perpetual futures. And these perpetual futures are basically a new financial innovation which offer a very high leverage. In fact, you can basically, unlike like other contracts or other traditional futures, you can leverage up to 100%. So you have to post a very little margin, and you can take, therefore, a large position with a very small leverage. And if you want to measure the cost of leverage, that's where the leverage cost comes into play, which is the main object of interest in this study. And we also have seen that there has been a lot of growth in smart contract-based finance with a lot of TVL locked, about 188 billions. And what makes this crypto market unique is basically the fact that there is no traditional valuation anchor. For example, you have cash flow, you don't have any cash flows, you don't have any dividend, right? It's different from traditional stock markets. But you have the funding grade mechanism, which is used to align the spot price with the future price, as we will show. And we also have a very high participation of retail investors. So this is very different from traditional finance, where in the future market, you typically have mostly wholesale or institutional investors. Here, you have a lot of retail investors participating as well. One question that we want to answer here is, what are the economic forces that are determining the funding rates of perpetual futures? And also we want to understand whether or not we can use funding rates to predict returns. So can we use funding rates to predict cryptocurrency returns, right? Both in the future and in the spot market. And ultimately, we want to understand whether there is an aggregate overall mechanism which is driving all this. So why do we observe, for example, predictability? Is there like some common economic mechanism that can explain this result and can help us connecting the speculative demand that we see in CeFi with the large capital inflows that you see in DeFi? And these are the main findings. Essentially, the first finding is that the leverage costs in the centralized market have a lot of interesting patterns. In fact, they possibly correlate with contemporaneous returns and over interest change. So that means that if the leverage cost goes up, then there will be an increase in the cryptocurrency returns, as well as there will be an increasing in demand. And our proxy for demand will be change in the open interest. And then we also see that they are negatively predicting subsequent spot and future returns. So if you look at the spot and future returns a week from now, or even longer, you will see that there is a negative relation. So basically, it means that if the funding rate goes up, then future returns in the spot and in the future market will go down. And we also observed that the funding rates in the centralized market, which is again proxy by the basis of these perpetual futures, are positively correlated with the TVL change, so with the change in total value locked for DeFi protocols. And results are economically very interesting and astonishing, because a 1% increase in the weekly funding rates leads to a 12% increase in the weekly DeFi TVL. So, and this is true across all blockchains. And also we observe that these results are even more sensitive or stronger for newer protocols. If you look at newer protocols or newer blockchains, you see that they are much more sensitive to funding rates. You see a larger response or sensitivity. And the common mechanism that we believe is explaining all these results is sentiment. And in fact, we basically argue that, and this is still a work in progress, that funding rates are essentially measuring the aggregate investor sentiment. So how large are the investors' beliefs about the future returns of assets? And leverage traders, which are exactly these investors who go long or short into the perpetual futures, must pay for their beliefs every 8 hours, right? Because, the mechanism that we will discuss is basically requiring to remunerate the margins every 8 hours. And Another interesting point is that because these DeFi projects are difficult to value, right? Because they are not really linked to any cash flow, dividend, or anything that is traditionally related to the stock market or to the asset prices, that we are very familiar with. Here, the inflows are mainly driven by sentiment. So depending on whether people believe that the asset will keep going up, then they enter into this contract. Otherwise, they will exit. So just some background on perpetual futures. These were originally proposed by Schiller. So it's not a completely new concept, right, in the traditional finance, but it's a new concept in this crypto market. And the original idea, when they were introduced, is to create some perpetual claims on illiquid assets. Typically, these are real estate, human capital, housing, right? They want to create some claims on those assets, and they want to concentrate. The idea was to concentrate liquidity into a single contract to avoid like fragmentation of liquidity. For example, an alternative will be that you might enter into a position and then you might exit and rolling over the contract, right? So that would be an alternative mechanism, but this is typically more costly because you have to pay the exit cost and you have to enter into a new contract, so new transaction costs. But because this contract never expires, there must be a mechanism to align the future price to the spot price. And this mechanism is exactly the funding rate. First was implemented by BitMEX, which is like larger crypto exchange. And now perpetual futures are very widely adopted across multiple exchanges. For example, they trade 10 more volume than the spot. So it's really larger than the spot, right? You might think that the spot is, I mean, at least the first time when I looked at it, I was surprised that it's like such a larger market compared to the spot. They allow for a large leverage. So the maximum leverage is 50 to 100 times the initial margin. And if you compare this with the CME, Bitcoin futures, which are like calendar futures, not perpetual futures, the maximum leverage there is 1 time the initial margin. So they allow for a larger, increasingly higher leverage. And in fact, CME is now constructing also their own version of per future. So this is, again, an asset class that is emerging and is getting more and more importance. Now, as I mentioned, there must be a mechanism to align the future with the spot price, which means the perpetual future with the spot price. And this mechanism is the funding rate. And essentially what the funding rate is the difference between the future and the spot price that is paid in addition to an interest. So if you enter into this contract and you are long and the funding rate is positive, it means that the future is larger than the spot. So 8 hours from now, you need to pay to the short party the difference between the long and the, this basis, like the difference between future and spot over spot plus the interest. If you're short, instead, you would be receiving, and vice versa. If the future price goes below the spot price, the opposite happens, which means that the short part will pay the long part. These contracts have been also analyzed in the context of mostly understanding what type of no arbitrage relationship there should be between future and spot. That's not really our main objective here. Whereas our objective is really to understand how this perpetual future funding rate can be predictive of demand and as well as of returns in these crypto assets. So we look at funding rate data that we get from Tardis.dev. Tardis.dev is basically a platform where you can get order by order data from the centralized limit order book. You see funding rates, open interest, and we can see that for the main exchange. We have Binance, BitMEX, Bybit, OKX. And we also get DeFi TVL data from DeFi Llama, spanning a period going from August 2020 to June 2024 across the main blockchains. So we look at both new and old blockchains like Ethereum and Bitcoin, but we also look at Polygon, Terra, Solana, so more recent blockchain. And how do we construct the open interest, the funding rate measure? We basically compute an index for the funding rate measure. We aggregate across all exchanges weighted by the open interest. So an exchange which has a larger open interest than another will basically be contributing more to this funding rate measure. And then we compute open-to-open returns. So we look at the difference between open price minus the open price of the day before. And this is basically how we are computing the returns. And then we proxy the market funding rate with the Bitcoin funding rate. The idea being that Bitcoin is basically acting as a market factor. Like if you do a PCA of all the cryptocurrency returns, you will see that they are very positively correlated with the Bitcoin return. So just to give you an idea, the distribution of funding rates and change in open interest is very skewed. In fact, you see that the mean is about 2 basis points daily, right? And but the mean and the max are like -1 and 0.74, right? So there is a very high skew both for the funding rate and for the change in open interest. And you can have both a positive and negative extreme. When things goes bad, for example, you see that the future price compared to the spot goes down significantly. For example, in the case when we have crashes of exchanges, such as FTX. And first finding is basically seeing that there is some heterogeneity in terms of the funding rate. If you regress the funding rate of each individual exchange with each individual cryptocurrency with the funding rate of the market, which is the Bitcoin funding rate, you will see that there is a positive correlation. So there is a premium that is being paid for holding those cryptocurrency assets. But you also see that the relation is positive and is heterogeneous across protocols, which again means that newer assets, for example, Solana and Luna, are much more sensitive to the Bitcoin funding rate, right? So there is a lot of enthusiasm about holding these newer assets. If you look at if you regress the funding rate, the change in the funding rate versus the cryptocurrency returns and change in open interest, you will see that the relation is also positive, which means that if the funding rate goes up, then there will be more, there will be a positive demand, so the investors will demand more of these assets. They want to enter more into these contracts, and also the corresponding cryptocurrency return will go up. So that's basically a signal that there is somewhat an enthusiasm about the assets, so people want to enter and hold these positions. And then you see also that if you try to predict future returns, so again, how does change in funding rates is related to future returns, not contemporaneous returns, but future returns, you see that the relation becomes negative, which means that funding rates are essentially negatively forecasting future returns. So they are like negatively correlated to that. And the results are basically very robust. It depends, you can also compute this at the monthly horizon instead of the weekly horizon. And they also hold if instead of looking at the return on the futures, you look at the return on the spot. So there is this negative correlation. So bottom line is that there is a positive contemporaneous correlation between funding rates and cryptocurrency return, but there is a negative correlation between funding rates and future returns. And interesting, you also see that if you look at the change in TVL, so how much total value is locked in the main DeFi blockchain and DeFi protocols, you see that it's positively correlated with the quickly funding rate. So as the funding rate increases, there will be more inflow going into these DeFi protocols. You see that it's positively correlated across all the blockchains that we are looking at, like Total, Ethereum, Polygon, Binance Smart Chain, Terra, and Solana. And if you look at the coefficients, you see that they are larger for the newer blockchains. So again, for the newer assets, like blockchain in this case, you see that there is a more intention to hold or to go into these DeFi protocols. So finally, we were trying to understand, okay, how can we explain all these results, right? And the one explanation that we think is very plausible here is basically the economics, the sentiment story. So the idea is that if you think about newer crypto funding, for example, Solana or Luna, as I've shown you in the table, they are 3 to 4 times more sensitive to the Bitcoin funding rate, which again, the Bitcoin funding rate acts as an aggregate crypto sentiment proxy. And this is basically also consistent with some literature in traditional finance, which says that if you look at younger, hard-to-value speculative assets, typically these have correlated with a higher investment sensitivity. So investors are more sensitive in terms of sentiment to newer assets, to like securities that are typically younger, they are not easy to value, and they are very speculative. And also, if we look at the demand pressure, this is also a proxy for the sentiment. In fact, we see that if the funding rate is going up, as remember, I showed you in the table, the demand goes up in terms of change in open interest, and also the contemporaneous returns are going up, which again can be interpreted as the fact that investors who are optimistic, so they want to demand more This is basically leading to an increase in the funding rate because the future relative to the spot goes up if everybody wants to enter into this contract. So in a way, what you see is that this funding is what we define a costly reveal investor sentiment measure. So it's basically reflecting the sentiment of the investors, but this is not really sentiment that you see on Twitter or on Reddit where investors or people are speaking without paying any cost, right? It's not really cheap tools, but rather they are paying, right, to express their sentiments because they are paying this funding rate every 8 hours. So that's basically a sentiment story, which is like, again, coming with a payment. And we also see that, as I mentioned, the funding rates going up are basically negatively correlated with subsequent returns. So they are negatively predicting future prices, which is essentially consistent with the story of predictable return reversal. So there is a return reversal, the price, and in a way, overshoot it too much relative to where it should be, right? There has been a lot of momentum, a lot of enthusiasm that has led investors to buy this security, but over the longer term, because there's been an somewhat investment in the security, the price will rise because people will realize that indeed the price is way above what it should have been. And this is basically consistent with the strongest test of sentiment effects that are related to return reversion predictability. So again, there is this sentiment story, which is actually saying there is an overvaluation of the asset due to the fact that investors are very optimistic and therefore they keep that there is a momentum and they keep buying. And similarly, if you see the DeFi TVL, again, because of this sentiment, because investors are enthusiastic and they really want to invest and enter more into this asset, then they will also end up using more the underlying blockchain. So you see that there will be an increase in the inflow into DeFi protocols and DeFi blockchain, which again, if you think about the traditional finance story, it's like as if we are linking these flows, investment flows, to speculative style investing, so growth investing, right? They want to invest more into assets which have a higher potential for growth. And this is basically the DeFi, right? There's an asset, a protocol which has a higher prospectum in terms of growing. So conclusion is basically funding rates is basically what we believe to be a barometer for the sentiment of the investors, and these funding rate payments that happen every 8 hours are basically reflecting directly the sentiment of these crypto investors. And we show that this is can even have a very good trading signal, right? Because it predicts subsequent returns. So you have a negative correlation with subsequent returns. So you have positive correlation with the change in the open interest and existing returns. And it also results in a lot of inflow into TVL for blockchains. And I will stop here. Thank you.
Great. I think, was you a question?
Thank you very much, Agostino. Quick question. How do you deal with some kind of default risk, counterparty credit risk, right, with such high leverage?
Yeah. So the counterparty risk, of course, we haven't observed many events where there has been this counterparty risk. So there will be counterparty risk of the issue is that also if you are not basically making this payment, then the exchange will liquidate your position and you will basically be exiting the contract. So in a way, it's staying carrying the set automatically by the exchange.
So the 8 hours are sufficient?
There will be some liquidation procedure in place if you're not making the payments. Then in terms of, basically you can think of these funding rate payments as some collateral that you need to post on a regular basis, like precisely to market your position and prevent defaults. If you're not able to make this payment, it's like as if you are not meeting the margin call that you get from the investors. Yeah.
Great. I think we have one more question here.
Yeah.
How do your results reconcile with the traditional carry strategy in traditional finance? Do they go against or in the same direction as that, qualitatively?
The carry strategy, traditional finance, we haven't looked at it directly, so we need to think a little bit more, but it's, so far, I think what we observe is that basically there is this negative correlation between current current funding rates and future returns.
Awesome. I think you have one more question.
Hi, I was wondering if you were able to get data from FTX while they were solvent, given that there was a treasure trove of trading activity with Cook at the time.
Yeah, that's a good question. We haven't included the FTX data, but in principle, I think we were discussing with Sathya a few moments ago that we could introduce FTX as well. I think there are some slight differences because some slight things to take care of, because the mechanism that FTX was using to compute the funding rate and to market the position is slightly different than the one that we are using here for the other exchanges. But I think there might be a way to incorporate it into the analysis. We just have to massage it a little bit. That would be good.
Sorry, do you have time for another question?
Yeah.
Yeah, and I was wondering if when you saw the negative relationship, have you considered stratifying the level of funding rate? And the reason I'm asking is because what I notice non-scientifically, but what I notice is that typically the rate is positive when the market's trending positive and negative when it's trending negative, and then when the funding rate maxes out at higher percentages, that's when you would theoretically see the mean reversion.
Okay. So I think I think you are saying like controlling for somewhat the market factor. If the funding rate are positive, I mean, if we control for like the market factor, when the market is going up, then people will enter more into long position. If market is going down, people will get more into short position. And you're saying if you control for that, what would happen?
Yeah, like for example, if the funding rate's like 20% or under, the market typically is trending, and then when the funding rate gets really expensive, and then that could potentially be a mean reversion indicator.
Yeah, I will let my coders respond here. Like, I think this is a good point. We haven't.
So we looked into that, but with continuous data, it becomes an issue, right? Because there's some like look forward bias. You know where the cutoffs are. You could potentially dynamically z-score it. We haven't done a dynamic z-scoring, but we were concerned about basically the knowledge that it hit. Like, I think in the beginning of the sample period, it used to go extremely high and extremely low. Recently, due to like protocols like Athena, kind of the variation in the rate has been somewhat muffled. That since you have more arbitrage capital entering, you're not going to have these explosive ups and downs. But that's something we need to look into, and adding like a dynamic z-score maybe every year that rebalances to add cutoffs to see when the reversion points would happen.
Yeah, and I think with the FTX data, that would be very instructive.
Yeah, definitely interesting point.
Yeah, so I think maybe we can just take one last question.
Thanks for your talk, first off. You obviously mentioned that the 8-hour funding period is relatively standard in perps protocols. Counterfactually speaking, what happens to your results around sentiment and the reg table if the funding period were to be higher or lower than 8 hours, which is to say if the spot price were refreshed more frequently to the future price, rather vice versa?
Yeah, that's a good question. We haven't yet actually found a correlation between sentiment and funding rates. So this is like what we are currently doing. We think that this is sentiment, but if we are still working on establishing the ratio with funding rates and market measures of sentiment, such as Reddit or Twitter. And you're right that depending on right now we are using weekly change in funding rates. We have seen that the results are robust if we take into account that larger periods, such as monthly change in funding rates. So I think the results should still be robust with respect to the time horizon that you're using, but that's a good point. Maybe we could check what happens daily, weekly, and monthly. I think in terms of these regressions, it seems that the results, the coefficient stays the same in terms of sign. Now, in terms of value, of course, they will change, but I think it's a good question. We can definitely do that when we look at the correlation in terms of market sentiment and funding rates.
Thank you.
Right, terrific.
Yeah.
Please give another round of applause for our speaker.